Someone wants Ethereum exposure in a normal brokerage account, but they do not want a crypto wallet, a seed phrase, or an exchange login. A spot Ethereum ETF is built for that shortcut, but the shortcut changes what you own and what you can do with it. In plain English, a spot Ethereum ETF is a fund that trades on a stock exchange and is designed to track the price of Ether, the native asset of Ethereum. Instead of buying ETH directly, the investor buys shares of a fund that holds ETH or is backed by ETH exposure. This became a major crypto conversation because it brought Ethereum into a familiar Wall Street wrapper. In the United States, spot Ether ETF approvals moved from speculation to reality in 2024, with funds beginning to trade that July. So the question changed from will this exist to what exactly does it give investors? An ETF is not a new blockchain. It is a financial wrapper. The shares can trade during market hours through a brokerage, like many stock and commodity funds. The fund structure sits between the investor and the asset, turning direct crypto ownership into a regulated market product. The word spot matters. Spot usually means the fund is connected to the current market price of the asset, not a bet on a future contract expiring later. For a beginner, the easiest mental model is a fund trying to reflect today's ETH price through a share that trades on an exchange. A futures-based fund can behave differently because it gets exposure through contracts. Those contracts can create extra complexity when they are rolled from one month to another. A spot Ethereum ETF is meant to be more direct. Its main job is to track Ether itself, minus costs and tracking differences. The asset behind the story is Ether, usually called ETH. ETH is used on Ethereum to pay transaction fees, interact with apps, and help secure the network through staking. The ETF does not give you the full Ethereum user experience. It gives price exposure to the asset inside a traditional account. The simple flow looks like this. The fund holds Ether through a professional custody setup. The investor buys ETF shares through a brokerage. The share price is designed to move close to the value of the ETH backing those shares. The investor deals with the brokerage, not the Ethereum blockchain directly. Custody is one of the biggest differences. If you buy ETH directly and self-custody it, you control the private keys. If you buy a spot Ethereum ETF, the fund's custodian handles the asset. That can feel easier, but it also means you are trusting institutions and legal agreements instead of holding keys yourself. For many people, the appeal is convenience. There is no seed phrase to write down. There is no hardware wallet to set up. There is no need to send a test transaction. The trade happens in the same place someone might already hold stocks, index funds, or retirement account assets. But convenience is not magic. When you remove wallet responsibility, you also remove wallet control. You cannot withdraw the ETH to your own address. You cannot use it to pay gas. You cannot connect it to a DeFi app. You own fund shares, not spendable ETH in your wallet. If this kind of plain English crypto breakdown helps, consider subscribing. We are going to keep following the practical questions that matter, not the hype. Now, let's look at what actually happens inside the fund, because that is where many ETF misunderstandings begin. Think of the fund like a warehouse receipt system. The warehouse holds the asset, and the receipt trades in the market. In this case, the asset is ETH custody, and the receipt is the ETF share. The receipt can be convenient, but it is not the same as walking into the warehouse yourself. Each trading day, the fund calculates the value of what it holds. This is often called net asset value. If the market price of the ETF share drifts too far from the value of the ETH behind it, large market participants can help close that gap through creation and redemption mechanisms. Creation and redemption are the plumbing of ETFs. Authorized participants can create new ETF shares or redeem existing ones in large blocks. Depending on the product rules, that process may involve cash or in-kind asset transfers. The goal is to keep the ETF trading close to the value of its holdings. Even when the structure works well, the ETF will not match ETH perfectly forever. Fees reduce returns over time. Market spreads can affect entry and exit prices. The share may trade at a small premium or discount. For long-term understanding, the ETF is price exposure, not a perfect clone of holding ETH. The management fee is the clearest ongoing cost. The fund sponsor charges a fee for running the product, arranging custody, reporting, and maintaining the structure. Direct ETH ownership has different costs, like exchange fees, wallet costs, and transaction fees. The point is not that one is free, the costs are just different. When people say a spot Ethereum ETF gives regulated exposure, they usually mean the fund trades on a regulated securities exchange, uses public filings, and fits into existing brokerage systems. That does not mean Ethereum itself becomes risk-free. It means the access route is more familiar to traditional investors. A key misunderstanding is thinking approval means endorsement. It does not. Regulatory approval for trading a product is not the same as saying the asset is safe, cheap, or guaranteed to rise. It means the product met the applicable listing and disclosure requirements at that time. Some institutions cannot easily hold crypto directly. Their rules may require qualified custodians, audited statements, approved brokers, or specific account systems. An ETF can make ETH exposure easier to fit into those processes. That is one reason people still talk about these products beyond crypto-native circles. For an ordinary investor, the appeal can be simpler. They may want exposure inside an account they already understand. They may prefer a tax form from a brokerage instead of export files from several crypto platforms. They may also want to avoid the fear of sending coins to the wrong address. A plain spot Ethereum ETF does not automatically include the broader Ethereum economy. It does not give direct access to NFTs, lending protocols, decentralized exchanges, or on-chain governance discussions. It is not a ticket to use Ethereum apps. It is a market product designed around ETH price exposure. Staking is one of the most common questions. Ethereum uses proof of stake, which means validators lock ETH to help secure the network and can earn rewards. The original US spot Ethereum ETFs launched without staking. That means shareholders got ETH price exposure, but not the staking yield that direct stakers may receive. Staking inside a fund is not as simple as pressing a button. It raises questions about liquidity, validator risk, slashing, custody, tax treatment, and regulation. Product rules can also change over time, and new products can be proposed. A beginner should always check the current prospectus instead of assuming every ETH fund stakes. Self-custody is the opposite end of the spectrum. You hold ETH in your own wallet and control the private keys. That lets you move it, stake it, bridge it, or use it in apps. It also means a lost seed phrase, malware attack, or mistaken transaction can become your problem immediately. Holding ETH on a crypto exchange sits somewhere in the middle. It may be easier than self-custody, and it may allow withdrawals or staking features, but it introduces platform risk. An ETF moves the experience into a securities brokerage, while still depending on fund operators, custodians, and market infrastructure. A spot Bitcoin ETF and a spot Ethereum ETF may look similar from the brokerage screen, but the assets are different. Bitcoin is usually discussed as digital scarcity and settlement. Ethereum is discussed as a programmable network for applications. So an ETH ETF tracks the asset, but not every use case built around the network. Compared with a network like Solana, Ethereum has a different design history, developer culture, scaling roadmap, and fee structure. A spot Ethereum ETF is not a bet on every smart contract chain. It is specifically exposure to ETH, which is tied to Ethereum's own network demand, monetary rules, and market perception. Another beginner confusion is Layer 2 networks. Many Ethereum users now interact through rollups in scaling networks. A spot Ethereum ETF does not hold tokens from every Layer 2 project. It holds ETH exposure. The value conversation may include Ethereum's ecosystem, but the fund itself is much narrower than the full ecosystem map. ETF shares trade during stock market hours. Ethereum itself trades all day, every day across global crypto markets. That creates a practical difference. If ETH moves sharply overnight or on a weekend, an ETF investor may not be able to react until the exchange opens again. Liquidity matters too. A popular ETF may have tighter spreads and deeper trading than a smaller product, but liquidity can still change during stress. The price you see and the price you get can differ, especially around fast markets. Beginners should understand that an ETF can be easy to trade, but not frictionless. The largest risk is still ETH volatility. The ETF wrapper does not smooth out the underlying asset. If ETH falls, a spot Ethereum ETF is designed to fall with it. If the Ethereum market becomes unstable, the share price can reflect that instability. The wrapper changes access, not the nature of the asset. There is also technology risk. Ethereum is a live network that depends on software, validators, clients, upgrades, and user behavior. Bugs, outages in related infrastructure, congestion, or security events can affect confidence and market pricing. The ETF holder may never touch the blockchain, but the asset exposure still depends on it. Custody risk does not disappear just because it is professional. The fund depends on systems that secure private keys, manage transfers, and follow internal controls. These setups are designed to reduce operational risk, but no system is beyond failure. The investor is relying on the fund's custody chain rather than personal custody habits. Regulatory risk also remains. Crypto rules can evolve, and agencies can change how they treat products, platforms, staking, disclosures, and market structure. A listed ETF can feel familiar, but the underlying asset class is still young compared with stocks and bonds. That uncertainty is part of the risk profile. Taxes and account rules can be another reason people look at ETFs. Brokerage products may fit more cleanly into existing reporting systems. But that does not mean the tax outcome is automatically simple for everyone. Account type, holding period, country, and product structure can matter, so this is an area for professional guidance. The biggest misconception is saying, I bought an Ethereum ETF, so I own Ethereum. Economically, you have exposure to ETH's price. Legally and practically, you own shares of a fund. That difference matters whenever you ask whether you can withdraw, stake, spend, bridge, or use the ETH yourself. A spot Ethereum ETF may make sense for someone who wants regulated brokerage exposure and does not need on-chain utility. It may not fit someone who wants to use Ethereum directly, run validators, interact with DeFi, or hold keys as a core principle. The right lens is use case, not hype. If you compare spot Ethereum ETFs, look beyond the ticker. Check the sponsor, fee, custodian, exchange, liquidity, premium or discount history, creation and redemption process, and whether the product has any staking language. The prospectus is boring on purpose, but it tells you what the fund can and cannot do. So the clean summary is this. A spot Ethereum ETF is a traditional market wrapper for ETH price exposure. It can make access easier, reporting cleaner, and custody more institutional. But it does not give you private keys, on-chain access, staking by default, or protection from ETH's volatility. The real question is not whether a spot Ethereum ETF is good or bad in every case. The real question is what problem you are trying to solve. Do you want ETH exposure in a brokerage account, or do you want to actually use Ethereum? Those are related, but they are not the same. If you still have questions, drop them in the comments. Ask about ETF custody, staking, Ethereum wallets, tax basics, or how ETH differs from Bitcoin. And if there is another crypto product you want explained without the noise, suggest the next topic below.